This always happens before a major market crash. The 5 common historical warning signs that precede sometimes the biggest crashes in history. So we have 1929, 1987, the year 2000, 2008, 2020, and now possibly the biggest crash in history, according to Robert Kiyosaki. Now look, I am not the purveyor of doom. I think you should protect the downside and then be optimistic about the upside. There's going to be bargain businesses. There's going to be bargain stocks. There's going to be probably more room for gold and silver to go up. There's going to be bargain properties. But it is also really important for you to know the facts. Now, there are 5 common traits that precede every single recession, depression, or crash. I've done a lot of research on this in the last 20 years. I actually became a millionaire in the last crash of 2008. I bought dozens of properties in the 70s, thousands pounds. I wish I could go back then. If I had a time machine, I'd buy Apple stock, some Bitcoin, and buy 10 times more properties. But I also have my own framework, which spells crash. These are the 5 main factors that precede and warn you of a crash. Now, I've also got 4 ways that you can protect yourself financially, whether it is something worse than a recession, or whether it is the Agenda 2030 for the New World Order, to own nothing and be happy. I've got 4 ways for you to protect yourself no matter what happens. So right now, we've got the stock market at all-time highs. We have average price to earnings ratios of the top companies double their long-term averages. They're over 30 times price to earnings ratios, where the normal average is around 15 times. Now, many of the top experts believe that AI is driving this further. There's going to be trillions pumped into AI. Much of that is not going to get a return for these big stock companies. When you have things like the Industrial Revolution, the internet revolution that we had, social media, there's trillions of dollars and pounds that get pumped into these markets. And you assume that people become billionaires from this, but actually it's only the few companies like the Magnificent Seven that end up surviving and thriving, and all others get wiped out. And many of these entire industries are net not profitable. They net lose money. And AI, there's trillions going in, and AI as an industry could net lose money, and it could be artificially pumping up the stock market. But we also have what's known as the Buffett indicator. Now, the Buffett indicator, obviously popularized by Warren Buffett, measures the total market capitalization of a country's stocks against its GDP. And this can give you a rough measure of whether we are over or undervalued in the stock market relative to the economy. Now, currently, as I speak to you, we are at 221% on the Warren Buffett indicator, which means that the US stock market value is 221% of the GDP of the entire nation. Now, look, what you want to do is buy low and hold, or buy low and sell high. Right now, flooding into the market because of false optimism and, the herd mentality, of sheep, is you've got loads of people pumping in at the top of the market. So there's a current market capitalization in the stock market of 55 trillion. That might go out of date after this video because it just seems to be growing all the time until it doesn't. And that is 221% of the total GDP of America. So that is very significant because it is a record high as of October 25, and that surpasses the previous record high of 200%. Can anyone guess when we had the previous record high on the Buffett indicator? And by the way, if you didn't know the Buffett indicator, you've already learned something here. It was the dot-com bubble. So back in the dot-com bubble, which was another one of these false markets where hundreds of billions went in, but most people lost money, there was 200% at peak on the Buffett indicator. And then, of course, we had that huge dot-com bubble crash. Now we're at 221% on the Buffett indicator. Now, I am not saying, therefore, that tomorrow afternoon we're going to have the biggest crash in history. In fact, it's Robert Kiyosaki who, quote, has said the biggest crash in history is coming, not me. And it's Michael Burry who's gone long on the Magnificent Seven and the S&P 500 to the tune of 1 billion, not me. I haven't bet against the stock market. I just move my money accordingly. Now, I will put my hands up and say that I have moved a significant amount of money out of the stock market. I managed to get a tax break on it, and then I've put it into real estate because I've just bought a property which was 5 million quid plus stamp duty in 2020, and I've just essentially paid 2.3 million for it. We're literally completing on it probably today. Wow. So I'm sort of hedging my bets that sometime around about now, all those profits in the last 20 years I've made in the stock market, I can materialize and crystallize and then move it into an asset that's of lower value. And that particular asset is commercial property in my town centre, which is really, really cheap. Again, this is not advice. I'm just sharing my experience of what I'm doing. Now, normally, I would probably just leave it in. Because if you look at the last 40 years, I think we've had 5 or 6 years only where the market has gone down, and then all other years the market has gone up. In fact, if you were the worst investor ever, and you were like, right, I am the worst investor in history, therefore I'm going to go all in just before the big crash of 1929. I'm going to go all in on just before the big crash of 1987, 2000, 2008, and 2020. As long as you didn't sell and you bought at the peak before each of the biggest crashes, you'd still be over 6% a year compounded in the markets, in the stock market, compared to about 10% if you didn't have the worst timing in history. So actually, even just leaving your money in and dollar cost averaging and buying in stages, you'll probably still be fine as long as you don't sell and as long as you don't materialize the loss. Now, these Buffett indicator record highs of 200% and 221% are driven by this massive growth in tech. And right now we've got Nvidia, who I think Nvidia's about 57x growth. And we've got all this AI hype. And we've got more trillions going into AI. I think there's 7.7 trillion sidelined. So what this could do is create even more of like this kind of bubble effect. And therefore, it could delay the correction. But of course, the longer these corrections, recessions, and depressions are delayed, usually the worse they are. Okay, so what have we got left to cover then? We've got the 5 warning signs that always happen before every crash that I've created my own framework for, which spells the word crash. And then we've got your 4 ways to protect yourself for the pending apocalypse. And this doesn't involve building a vault in your basement and buying 10 tons of condensed milk, or going and growing your own food in the Himalayas somewhere. It's still staying, within the Western society. Okay, so crashes show repeated red flags across these historical crashes of 29, the dot-com crash, 2008, Tulip Mania, and today the signs are all here to see. So the 5 key warning signs which spell crash are complacency, regulatory, ATHs, speculation, and high leverage. And what I'm going to do now is just break those down for you. So complacency is hype or overconfidence or FOMO, fear of missing out. It's investors ignoring proper risk and due diligence. They're just going on energy and momentum and hype and excitement and exuberance and overconfidence. And this time it'll be different stories because of AI and because of everything. And what it does is all the mainstream come in on the hype. I don't know if you noticed that now the mainstream is starting to talk about gold and silver. Now, I've been in gold and silver for 15 years. I was buying gold at $700 an ounce. I was buying silver at $11 an ounce. And even though I'm still bullish on gold and silver, I kind of wish no one was talking about it because it's pushing price up. It's creating scarcity of supply because of vast demand. So usually when everyone's talking about it, that's when you get the complacency, the hype, the overconfidence. Do you remember NFTs? You know, when everyone was talking about it, when Logan Paul and all these people were just buying £8 million NFTs, well, where have they gone? They're like the tulips. And social media, by the way, nowadays, it amplifies all this euphoria because you only have to have one or two people post about something like gold or Nvidia returns, and then all of a sudden it goes viral, then everyone's on it. Now, Tulip Mania, that equivalent was gossip, everyone whispering and gossiping. Do you know at one point there was tulips that were worth more than a house in Tulip Mania? I mean, how mad and ridiculous is that? Talk about forgetting the fundamentals and going on the hype. But of course, gossip spread much more slowly in 1630 than it does on social media now, where a post can go viral, in minutes. So how do you protect yourself from this? Well, I'm going to give you my 4 main ways to protect yourself at the end of this session. But really what you want to do is basically question everything, question the motives of whoever's offering you the investment opportunity, protect yourself by staging in your buying, so not going all in. I mean, warnings are, this investment sells itself. This will never go down. You know, you hear these things always through the cycles. And you probably want to be a bit wary of all the hype of these new innovations like AI. So you want a dollar cost average, which is investing in stages, and you want to diversify. Okay, so that's the C in my crash framework. The R is regulation or regulatory gaps. It can be over, but it's usually under regulation. So maybe lax regulatory rules allow for over-speculation. A good example of this was the banking crisis in 2008. The banks were basically allowed to do what they want. They were under-regulated. There were these ninja loans, no income, no job, no asset. And now everyone knows that if you have no income, no job, and no asset, you shouldn't be getting loans. Do you remember FTX with Sam Bankman-Fried? And people forgot that wasn't a decentralized crypto platform. It was just an exchange, i.e., it was someone else's bank. And if I said to you, oh, my name's Dave and I've got Dave Coin, just pay £100,000 into the Dave Coin bank account and you'll make millions. You'd be like, no fucking way, Dave. I don't want any Dave Coin. But that's essentially what happened with FTX, because it wasn't a decentralized crypto platform. So people are overhyped, overconfident, fear of missing out, low regulation, low intervention, and then bang, everything goes up in smoke. There was low regulation on NFTs. So what you need to do is protect yourself. If it seems too good to be true, it's probably too good to be true. There's a saying in business, if it walks like a duck and it quacks like a duck, it's probably a fucking duck. So just be careful and just make sure that your investment is at least protected or regulated or at least decentralized. A is all-time highs. So the thing with all-time highs is you don't know if next month or next year could be an even newer, bigger all-time high. So you only really know the all-time highs going back. But if you've had all-time high after all-time high after all-time high, and you're over 200% on the Warren Buffett indicator, of which we are now 221%, it's probably a warning. It's not necessarily a warning to sell everything or bet $1 billion on a crash like the big short guy, but it certainly might be a warning to spread your investments into other classes like Rolex Daytonas, like gold, like silver, etc., and not be all in, say, just the stock market. And when you've got assets and companies that soar past their usual average earnings, this is another warning sign of all-time hypes. Well, actually, ATH is all-time high, but it could be all-time hype. You've got hyped valuations beyond, genuine historical fundamentals. So the dot-com boom, the price-to-earnings ratios were 75x. and they're 30 odd X. At the moment, the NASDAQ was 35X. Nvidia is 57X. So check out these price to earnings averages, maybe de-risk with some gold and silver and spread across multiple industries. You know, tech's probably pretty good at the moment, but maybe it's overhyped. So go into some other industries. Okay, and then we've got speculation, which is the S. So speculation is obviously frenzy. It's buying in the bubbles. It's buying at the top. It's buying at all-time highs. It's dumb money. Smart money goes in first. Dumb money goes in last. Smart money comes out first. Dumb money comes out last. So do you remember the 1920s and chasing the penny stocks? Or these unprofitable IPOs in the 2000 crash? Japan's 1980s bubble led to a 40-year slump. So, you know, when people say things like the biggest crash in history or something worse than a recession, which can only be a depression because a depression is the only thing worse than a recession. And a lot of people are, oh, no, that will never happen to us. And they give every reason why it will never happen. Well, Japan went into a 40-year slump. So how do you protect yourself from speculation? 1, go back to fundamentals. 2, avoid FOMO. And then make sure that you're relatively liquid because generally having to sell at the wrong time is what wipes out investors. If you don't have to sell, it doesn't matter if your investments drop 20 or 30 or 40%, because as long as you hold, it will recover. Like I said, even if you bought at the peak before the worst crashes in history, as long as you held, you recover and then you overtake. So therefore, you want to keep some liquidity through this potential next crash so that if some of your assets do drop in value, you can ride it out. You can sit on your hands. And then the H of my crash framework is high leverage. So that is 100% mortgages, if you remember, in 2008. And actually, some of them were probably at 110 or 120%. Because not only had they given them 100% borrowing, but then there was negative equity because the property prices had come down. So you can actually be leveraged to more than 100%. A lot of people were over-leveraged in the recent Bitcoin and crypto crash or correction in late 2025. And a lot of people had gone long, being overly bullish and overconfident. So they were longing and they were creating a high leverage, and then they got caught with their pants down. So like someone even said to me recently, look, Rob, there's a shortage of gold and silver. You know, you should spread bet. You know, you should go long on it. It's going to go up. And I'm like, no, because that's not what I do. I'm not a bettor. I'm not a trader. I'm not a gambler. So that's at your own risk. I just BHD. Buy, hold, die. And if I sell from one asset, it's because I think it's overpriced and I move it into an asset that's underpriced, as long as I haven't got big sales costs and high taxation, because that can wipe out all your profits. This is another reason why most day traders or traders don't make any money, or only sell courses on it and don't actually make any money doing it, because you've got buying costs, selling costs, taxes, and that usually wipes out all your profit, even if you made a decent trade. So a good way to protect yourself from the C.R.A.S.H is to make sure you have some liquidity, so 3-6 months probably minimum liquidity. You're in some assets that are relatively liquid anyway. And maybe you can buy some assets that are undervalued, like commercial real estate is in the center of my city, from profits you've made in other assets. Gold and silver, as the world gets worse, gold and silver are likely to do better. I know billionaires who've said to me, I buy gold and silver and I hope it never goes up. And the reason that they hope gold and silver never goes up is gold and silver goes up when many other assets are going down, or economies are struggling, or there's wars or high inflation or geopolitical issues, all of which, other than the war, we have going on right now. Right, so how do you protect yourself? I said there's 4 ways to protect yourself. So number 1, don't panic sell. I'm not doing this to panic you, I'm doing this to prepare you. Don't panic sell, hold for as long as you can. The longer you hold, the more money you make. And if you haven't got a better alternative to the assets that you hold, just keep them and ride them out, which means you need liquidity And which means when you go in, you should dollar cost average or pound cost average on the way in. Lots of these big investors like Warren Buffett are very treasury or bond or cash heavy. So you might want to have a little bit more cash than you might normally plan to. Number two is just have a little bit more defensive as opposed to aggressive tendencies right now. So where I think you can be aggressive moving into, 2026 to 2030, I think you can be aggressive buying companies, growing companies, scaling through AI, creating content and information, leveraging social media. This is where I think you can be aggressive. I think you can be relatively aggressive buying certainly gold and silver. But where I think you might want to be defensive is maybe a bit less into the stock market than normal, maybe be a bit more realistic on your returns for the next few years because everyone's getting drunk on double-digit returns. And as much as we're saying be liquid and Warren Buffett's got all of this liquid, I still think it's quite a risk holding a lot of cash, obviously because of inflation, which I have it on good authority from an ex-chancellor of the UK that inflation is pretty much a strategy now, and it's probably going to be relatively high or much higher than their standard target. Okay, the next thing you can do to protect yourself is think about time in the market and not timing the market. Lots of people try and time the market. Even Warren Buffett says you can't time the market. It's all about time in the market. The longer you're in the market, the more the eighth wonder of the world of compounding kicks in. So BHD, buy, hold, die. Long-term investing, even when it dips, is better than trading in and trading out, because you've got buying costs, selling costs, broker fees. You have to sell it a bit lower than its actual market value, and then you've got taxes. And that could be 30 or even 40% of the asset, which could have wiped out your last 10 years of profit. But then the fourth thing, which a lot of people get scared of, because remember, observe the masses, do the opposite, and be greedy when others are fearful, and fearful when others are greedy. So actually, you do want to invest in these downturns and you do want to cash in on the crash and you want to make sure that you leverage this opportunity. Now, I want to come back to number 4, investing in the downturns in a minute, because I think it's smart to have more than one passport. So if your country goes to shit and you're in the West and what's going on in the UK continues, you can move over to Dubai quite quickly. I think it's important to have income from more than one country. So you've got global income in case the taxes keep going up and up and we get budget after budget in the UK or other countries, which tax us more and more and more. So I think these are other good things you can do to protect yourself from recessions, depressions, crashes, but also just what's going on in the world. So quick summary and key takeaways then before I summarize my fourth way to protect yourself. I'm going to go with Robert Kiyosaki and Michael Burry and Ray Dalio and, the head of JP Morgan and all these billionaires. I'm going to go with them and say that the crash that's coming is coming relatively soon, because it was nearly 17 years since the last one. So we're kind of due one. And with how bubblish everything is, I'm going to go with them and say that I think in the next 3 years a big crash is coming, and I think it's got a good chance of being the biggest crash in history. So there you go. I've put my flag in the ground, and if it doesn't happen, I'll be fine, and if it does happen, I'll be ready. And that's what I've done this piece of content for you for. So every crash looks a little bit different based on, is it the banks that created it, like 2008? Was it tulips? Was it NFTs? Was it the dot-com bubble? Was it AI? But there are the fundamentals underneath it. So, overconfidence, poor regulation, misunderstanding or being over bullish on innovation, excessive debt and leverage. And I've summarized these in my crash formula. So if you'd like to cash in on the crash and manage and multiply more money in the next 3 years maybe than you have in the last 30, I recommend you come and learn how to do this at the Live Moneymaker Summit. Now, actually, I only have one more planned date for the special, newly updated 3-day Money Maker Summit. Now, because I own the training suite, I bought the building with other people's money 12 years ago. Instead of having to pay 55 grand for the hotel and then another 15 grand sending my staff there, I actually own the buildings in which I run the Money Maker Summit. So I can pass those savings on to you, and for under 100 quid for an upgraded VIP ticket and barely any money, barely a few coffees for the standard, you can actually get in on the action. And also, because many of you who watch me online, we've not met yet face to face, I'll be at all 3 days live. I'll be sharing everything I know about making, managing and multiplying money, about cashing in on the crash, about building multiple streams of income, about starting and scaling your business, about getting your income streams up, your earning power up, and your tax bill down. There'll be sessions on learning how to invest in real estate with other people's money, in gold and silver and cryptos. I do a full 90-minute session, phones off, where I'll tell you the 12 different ways to save hundreds of thousands or millions in tax. All of these are basically tax breaks given to you by the Inland Revenue, but really complicated and most people don't understand them. I do, because I've been doing it for 20 years. So you get all of this for the cost of a few coffees on the following link. The link is robmore.live/MMS. And we've tailored a lot more of the newer content to cash in on the crash. Because how you invest in a crash is different from how you invest in a bull market. And you have to observe the masses and do the opposite. You have to be greedy when others are fearful, and fearful when others are greedy. I've been doing this 20 years. I've done nearly 300 million in sales. I'll teach you how to start a business. I'll teach you how to generate and turn browsers into buyers and generate leads at scale. I built the UK's largest property and business training company. And everything I know, I'll share with you. I'll do 2 money mindset bonus sessions each morning. I'll do 2 champagne reception Q&As. So you literally can't leave these 3 days without taking everything we've learned in 20 years and accessing my network and having the chance to ask me multiple questions. So final opportunity, first come, first serve. The link is robmore.live/MMS. Because something worse than a recession is coming, according to Ray Dalio. Warren Buffett has more cash than he's ever had, nearly 400 billion in Berkshire Hathaway, waiting to buy these stocks on the cheap. The big short guy has just shorted $1 billion on these big companies like Apple and Nvidia. Ray Dalio thinks it's going to be a depression. And I'm certainly going all in on commercial property and gold and silver and physical items. And I'm going to be running regular training inside the communities to help you do the same. So remember to invest for freedom, choice and profit. And remember, if you don't risk anything, you risk everything.